Well, the S&P learned how to go back up and have a green week. As we can see here, it's the first one in 5 weeks. I think it's important to note this is the first not only green week, but it's the first close of a higher high. Where does this take us remains to be seen. There's a lot to go over here. Now, for those that have been watching these videos for some time, you know I view the market as the macro, the fundamental, and the technical. And in every single one of those, you have different time frames. That's a very important concept that you're going to go through a lot with me today. So you know how to use the data that we go over today, whether that data is macro, fundamental, technical, and how to use it in the time frame in which you're trading. This is a really important concept that a lot of people overlook. We're going to collect a lot of the dots. For example, what happened with the 10-year during the FOMC and Bank of Japan this week, to the dollar and why its holding is paramount to everyone, including tech day traders. Let's get to it. Quick reminder, 27.5% of you do not subscribe to the channel, yet you watch these videos and they all come out at different times. I would suggest hitting the subscribe button and all notifications so that you are made aware if you want to follow along with us during the week. So when we start with the basics, we all obviously can see just the very simple trend line here and how we've broken that trend line, and we've even come back and retested it. There's a little more to it than that if we just take a second and look at the breadth. Now, not looking at the breadth is probably one of the worst things that you could do because it just tells you a very quick objective story. And what we're always looking for is that 50% line. So we're going to look at these just one by one before we get into a lot more technicals here. And what we always want to do is we always want to be above that 50% line. And a lot of people say, well, why? Why does it matter? And what I'll just do is just drop a pin for those that are newer and haven't seen this before, but it just makes your life so easy. It's like, oh, look how smart I am when we're above that. I'm super smart. I'm the smartest guy out there. Everything I touch works. And then when it breaks down, it's like, why do I sit on a throne of lies? Nothing I'm doing is working. It's real simple. When you have the underlying pinning of the market or you don't have the underlying pinning of the market, the technicals will tell you that. And they're telling you right now, very simply, that long-term, we don't have it. And this is very important to get because this means that a lot of the stuff that we're doing, you're trying to thread a needle when you're buying down here to an extent. But there's different ways to determine this. But wait, there's more. So if you're a long-term guy and you're a long-term investor and you're looking at this, you're not doing cartwheels. Now, this is where it gets super interesting because trough valuations of this do present an opportunity. So you have to wonder, are you at a trough valuation? Are you not? I don't have an answer to that, and I want to be real clear. Nobody knows this. We're going to point some things out today that I think are absolutely glaring. But these are areas where you have gotten to before and held. I like puke levels. I like when I see just absolute blood in the streets, absolute fear. It's such a great time to buy. Stock market's never coming back. It's going to be down here for years, blah, blah, blah. And then miraculously, as it's done since its inception, it comes back. It's very different if you are a day trader or a swing trader, right? We all know the difference between long-term investing, going out years, and going out weeks or months or days. So if we look at the 50, and this is the one that institutions really focus on. And if we just do something as simplistic as just drop a line here and then go, okay, well, are we up or down over that? Well, we're under, but we're not as bad as we were before. Oh, okay, so we had more stocks here under their 50-day moving average than we do right now? Yes. So what is that telling you? It's telling you something pretty significant, and that's why we're doing these one by one. So let's get to it. So here, I had more stocks, their 50-day moving average, than I do here. So if you ever look at the market, and I walk through what these moving averages are to me and how I view them, the very first one that I always talk about is the 55. And I use a 55, you should use a 50. You should use whatever you're comfortable with. And I have a declining 55. So not for nothing, but that's not great. And we all know that that's not great. We're not telling you anything you don't know. If you're in the community, you already know this. This isn't great. You know the 200's down here. You know you might get a death cross. Death cross is when the 50 crosses the 200. So we look at this and go, well, I've seen great before. This is not a photo of it. And so watching it here, you'd have to think that you're still going to have to come up. You still have to retest this area eventually and go from there. But the underlying pinnings here are what I find most fascinating. So when we see divergences, and you would say, well, how is this a divergence? I'm glad you asked. I like looking back at history and I like looking at situations and then saying, okay, what happened in this situation when you had a divergence? So for example, I had one right here. And what's a divergence? It's when the stock market does one thing and the underlying indicator, this is an indicator, percentages of stocks under or over the 55 does another. And we can see here the September 22nd. This is when we had the worst CPI reading that we've ever had in years. This is actually on this Friday. It's so fascinating because on this Friday in here, that's when we had the worst Michigan consumer sentiment expectations we had in years. If you're interested in this stuff, there's a really good book called Mark Boucher, by Mark Boucher, and it's called The Hedge Fund Edge, and he gets into all this stuff. It's really good book, really good trader, actually a great trader, and worth reading. Older book, but for me, I like. Anyway, what do you have here? I'm glad you asked. You have another divergence. I think when you see these, you just want to pay attention. Does it mean that you're just going to automatically go up and rally? It does not. No, it does not mean that. But what I've always taken away from divergences is this. When I see them, the more absolutely glaring that divergence is, the more you better pay attention to it. And this one's pretty much absolutely glaring. What does this mean? It means that the response to it is equal and opposite. So when you have one of the biggest drops that you've ever had, you can have one of the fastest back rallies that you've ever had. Remember, CTAs, for example, those systematic funds got out of billions and billions of dollars as fast as they possibly can. We had a lot moving on here. But before we get back into more of the technicals, really important concept, really important for people to get. Does it mean it's just going to go up on Monday and that your calls are going to work out for you? No, but it does mean like, hey, I better pay attention to this. And there was some more, but wait, there's more. So then you get to the 20. And of course, I'm just going to leave these in because then you're going to be like, that even worked on the 20 here. Isn't that fascinating how that works? But someone will tell me this time again. So, and it doesn't matter. Declining 55, declining 55, declining 55. Which is, again, not great. You should never buy a declining 55. But the people that bought here, how'd they do? Pretty well. See, what I try to do with these videos is I just want you to start thinking differently. It's like I had someone the other day, we were just talking about like, you never buy a stage 4. Well, if you never buy a stage 4, then you're never, like when you have these stages when people talk about their trades, right? And they all talk about this and goes, well, you're never supposed to buy a stage 4. So here's 1, 4. And then you'll get something down here and they're like, it's not a stage 1 yet. Well, what are you supposed to buy? Do you want to buy here? Or do you want to try to figure out if there's ways that you could figure out how to get in here and buy the turn? I want to figure out if I can get in on the turns. If that's not what you want to do, then just wait for the trend and just get mediocre returns. I mean, everyone's entitled to get out of the market what they want. But what you're getting here, if you don't have a system like that, you're not looking at when this stuff might be at trough valuations. That's what traders are doing. And so when we see this stuff, we have to go and go, you know what, we're just not as bad as we were on the breath here. I mean, I get it. Like this was a dumpster fire. Like this was brutal for people that didn't know what to do. And I get it. I do. And you don't know which way to move, and you have tariffs, and you have a bunch of other stuff going on. Here's what I thought was really interesting. Here we are on the 5, and they puked us on the 5. So what I saw happen on Friday, and we'll get into it, but I saw massive rotation out and into beaten down there. And this is solidifying that. So in other words, if you start looking at the sectors that were working, the safer sectors, the insurance sectors, the XLP names, and I'll give you an example here just very quickly before we get into the technicals. But if you start looking at like the XLP names, like they're getting out of the XLP name. It's kind of interesting, even XLV is holding, but they're getting out of that stuff. And then you start going, well, why are they doing that? It was the same when you looked at like the DAX for a couple days. Now the DAX is weak, or you start looking at China, and China's been weak for a couple days. And then you start looking at something like the Qs, and you're like, well, that's interesting. The Qs keep trying to break this one level. Whether they do it or not, we don't know. But where's the money going? We'll get into the technicals here in a second, but this is a really important concept to get because what I tend to see with people here, and again, the whole purpose of this is to try to get you to think differently. Well, this is bad. No, like on the 5, this is exactly what you want. Like you could not technically, from a breadth perspective, them getting out of the other side of the trade and then watching some of these tech names, like the momentum names, move is exactly what you wanted to see. And you can see that even something like here, where you're like, wait a minute, you mean they've been buying momentum names since back here? Yeah, they've been buying momentum names. And everyone's sitting here waiting for something miraculous to happen, right? And this is why I always bring this up, because I see this everywhere. I got to wait for it. I got to wait for it to cross the 5-day. And then I need the 5-day to point up. Well, how's that going? The people that bought here, they're selling to you, right? You want to keep that in mind, right? Different tools, different times. It's like the one that I keep bringing up over and over again because it was, as I like to say, absolutely glaring. I'll get rid of my 4,000 levels. Is, I don't want to buy before the 5 is pointing up. Okay. Well, that's the day that you bought, right? We're in here and we're selling to you. And then you see this conference, and it was just an absolute dumpster fire. But we'll get more on that conference in a little bit here. The important thing that you need to take from all of this when you're looking at the S&P or you're looking at S&P breadth and you look at it as a whole is go, what do I really have going on here? Well, long term, this is not great. If you're trying to swing or you're trying to be long, you really want this above 50. You really want the SFI above 50 if you're trying to do this. And again, the 20 is more of an intermediate, but the best thing that happened was that the 5 dropped because at the end of Friday, if you really look at Thursday and Friday's action, after the Fed, they were getting out of the low beta safer sector and they were rotating back into other sectors. Well, I'll get into a couple of those sectors for you in a bit here. Very important concept to get before we get into the technicals of the market. To be clear, best strategies in this situation are the people that are looking for trough levels to get in on very long-term trades and those that are doing the short-term trades to make money and get out of the way. The guy that's doing the 1 to 2 to 3 day trade, you'll note that on the week they were the best, where if you held for a couple weeks, you're getting slapped around now and you can't figure out why. Really important to get. It's got everything to do with the breadth of the market. If you ever just want to take a snapshot and look at it, you just take a sliver of it and look at what's going on during that period of time. Really makes your life super, super easy. I'm just going to reiterate, I have a lot to go over. There are parts of this video you're probably going to want to timestamp and watch again. So we start here and we just have the very simple trend line and we can see that we've made that higher high. The very first thing I would do is I would start understanding that you want to know where peak is. And understanding that from that peak VWAP, you want to mark that off and then see how you react there. I'm doing the S&P versus doing the futures and the SPY because I got asked, why don't you just do the index so that it can work for both people. So if there's an issue and you'd rather see the futures, let me know. If you'd rather see the SPY, let me know. But until then, I think I'm just going to go back and just do the SPX. You can see our level right here, which is going to take us to that July level. Now that is obviously the negative CPI. If you go back and look at history, that is your negative CPI level. We obviously know that this is when everyone panicked because what was going to happen here was just awful. It was when Japan decided that they were going to raise rates and that lasted for a whopping 3 days. And then we go forward, we see the peaks here. Now, as you're trying to get over this level, the question is, are you, aren't you? I don't know. And neither does anybody else. I think you're seeing the forming of the possibility that we could, but you've already tried 3 times, bonk, 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 and you're not able to do it. The only thing that I really liked about the action on Friday and the ability that maybe we can is the liquidity grab. So in other words, you come down and you try to grab everything that you can, and then it doesn't break, and then you close at the high of the day. There's actually methodologies on this where you rip down and then lift higher. And there's actually a really good study that I'll go over in a little bit here that talks about this, where you're down and then after you're down on the lower percentage, when you flip like this, it's usually some kind of short-term bottom. What I would do is mark off this bar because this bar is that Michigan consumer sentiment data, and that's significant. It's a significant level. Now, you have a lot of other indicators that we're going to go through very quickly because I have a ton to go over, but the most absolutely glaring one is just MACD crosses all over the place. For me, looking at this and just marking levels off like that, is there value in that? Yeah, I think there is. I'm going to get rid of this one for a minute. Get rid of that. We're not going to have time now. But you'd want to have that in there. And you have to be careful. Like you could put VWAPs and VWAP all over yourself. Do you know where you were in August? Yeah, you do. So then you could see, okay, well, that's got a couple pieces of confluence there. Definitely going to be of issue for sure. And then you'd go back here to April 19th and you'd go, oh, geez, that might be a problem. Yeah, there are issues there. And maybe we're going to get through that. Maybe we're not. Maybe there's too much there. And then you would just do the simplest of things and throw in a 12, a 22, and a 55. Look at all that volume. I wonder who bought that day. And you just come out there. You think that's retail buying? And then just kind of come back and go, wow, when was the last time the S&P had that kind of volume? 2016. You mean you didn't even have that kind of volume on a bottom buy during the pandemic? No, just another little helpful tip. So then we just keep rocking and rolling and go, all right, well, here's that S&P level right here that ties right with the 22. Here's a 12, here's a 22 and a 50, or I'm sorry, a 12, a 22 and a 55. You should use what you're comfortable with. Sort of wearing blue light glasses again, make all the difference in the world, man. But sometimes the blue light actually cuts out some of the, well, quote, light that you're looking at when you're looking at colors. But I think this is a really important concept to get. And then you just do the simplest of things because everyone's going to bring it up. But you're not talking about the 200-day. Yeah, I see it, man. It's right here. and we've been below it for more than 3 to 5 days, and it's not great. But this is the hand that we're dealt. So we can either cry about it or we can play it. I would prefer to play it and then go from there. So, and I don't like this. I mean, look, let's call it what it is before we get into some more of the technical side of this. When you see something like this, and this is your 200, and you have a 212 cross, it's just a matter of time before you have the 222, the 255 cross, and you have what we refer to as the death cross. That weighs on you. That weighs on the market. It's like literally a weight on you when you're in the water. So it becomes very difficult for anything to really work here. And then you have to go through the uncertainty. But what I always refer to, and what I try to get people to understand, is as fast as you drop on any move is as fast as you can bounce. It doesn't mean it lasts. But that means to me that when I see the veracity of a drop like this, that's how fast they come back. They might not stay there, but the short squeezes that you will go through, and when people realize that, gee, maybe they went too far in Europe or Asia, and I'm not saying that they did long term. I think there's some really good opportunities there. But it does mean that in the short term, they may have done that. So what I tend to do when someone's going to bring up and be Captain Obvious about things is I'll go back through history and just look at it and go, is this something that I want to pay attention to? Well, here's a death cross. And if you sold the death cross, you sold at the low. Okay, here's the golden cross. If you bought there, you did very well. Here's the death cross. If you sold there on that day, you had a huge bounce and you went back through it. And then, of course, what happened? Well, you got killed. So understand your time frame when you're talking about it. Here's your golden cross. How'd that work out? Amazing. You made a fortune. If you get it, you get it. If you don't get it, you don't get it. And that's the hand, again, that you have. So if we look at it from that perspective, how do you know when it's coming? I'm glad you asked. See these two numbers right here? So you watch these numbers, and this is 57.49, and this is 59.16.73. So all I do is I just start here and go, oh, all right, from this area, I'm about 50 points away from those two, and then you just start watching it move. And what it will do is it'll give you a number. So let's say that number, roughly, if we look at that number, is going to tell you that you're going from 49 over to 46, and the other one's going 6. So every day you're moving, let's call it 12 or 15 points. So if you went and looked at those two numbers and you said how far you are a point from each other, you have to think that roughly within about 10 to 15 trading days on average, probably 2 weeks, if you stay under the 200, you're going to get a death cross. Could you trade up over it before then or not? Absolutely. Does that mean it's going to happen? Nope. Let's get to it. If you've been watching this channel for some time, you know I like looking at research, and I like taking a step back and looking at it from about 34,000 feet sometimes just to see what's really going on. And even if you're day trading, this is extremely helpful because it just tells you the climate you're in on a fundamental basis. Very clearly, this is not by me, and this is by Yardeni Research. If you do not get the free newsletter, there will be a link here up top. Simply click on that link. It's a free newsletter. It comes out daily. Saturdays is packed with charts. Mondays is packed with what I think are the most important articles of the week. Again, it's free and it does come out daily, but those Saturdays and Mondays, they're the real big ones. So let's just keep going here. Again, that is free. When I see this chart, it's pretty telling. And let's just go through what it's telling. So the forward PE of March right now of the entire S&P is at 20. And I think that's, it's something. It's not great, but for Yardeni and what he's going to say here, it's kind of interesting where he's already going with it. And if you really read between the lines, he's telling you what he's. And a lot of this research and this link will be included in that free newsletter. But I've been listening to this guy and following this guy for about 25 years. His fundamental stuff, like the big picture, 34,000 feet stuff, he's on Twitter too. He'll post these articles. You want to look at this stuff because it just tells you the things that are important that the institutions are actually paying attention to. So here's the forward PE, and we can see that the forward PE is in blue. We can see that the forward PS, which is price to sales, is 2.7, and we can see that that's right here. And then we can see that every pink area is going to be a bear market, and every, I don't know what you would call this, let's call it light blue area is going to be a correction. Why he chose those colors? Well, I have no idea. But you can see the disparity here between the two. And one of the things that really stuck out to me was that the price to sales is significantly higher than when we peaked or came close to peaking last time. That's definitely an issue for me, understanding that and going, okay, well, price to sales is significantly higher on the entire market than where we are last time, especially when you're in a macro environment like where we are, where sales could be affected by things like, let's say, tariffs. So we have to look at everything that's going on. And this is why it's so important as a trader for you to understand your time frame. Is your time frame months? Is it weeks? Is it days? Because why you might say, well, this is not a big deal, If the market rallies up and rolls over, well, you could be like, yeah, well, you're still expensive. If you're day trading, you'd be like, yeah, but this does still wait on that because institutions aren't going to step in. See, we can look at the technicals all we want, but if we don't know what's really holding the technicals up or down, it becomes a problem. So you need at least an understanding of it. Now, after we cracked here, and you can see the disparity between these two, you stayed price to sales higher than the PE. And if you look through history, that really hasn't been the way that it's been. And that's okay. It's really not that big of a deal. Where the big deal to me becomes whether price to sales is high or price to earnings is high. People will make an argument about that. Earnings should be higher than sales on a percentage basis on the chart. I don't view it that way. Where I have issue, or where I would take issue with this, to me, is the difference and the spread between the two. So when I look at something like this, and I look at something like this from where we peak to peak, or now we are peak to peak, that matters more to me than anything. And the reason for that is because the discrepancy between sales and earning. If you think about what that difference is going to be, it's only one thing. If you have a lot of sales and your earnings are going there and your earnings are different, well, it's going to be gross margins. It's going to be what you're earning. So if we see this, and we know that we're dealing with tariffs, it's possible that this discrepancy gets wider. And with uncertainty, that's a real problem. So sometimes I get asked when I show these graphs and spend so much time on them, what are you getting at? I'm getting at if the tariffs don't get under control and the spread between price to sales being at these levels, which is obviously very high comparison on any relative basis since he started charting it. If we look at it from that perspective, the price to sales may come in, but the PE is going to suffer, the forward PE is going to suffer even more. With that uncertainty, you start doing certain things. See, the thing about the market is it's a discounting mechanism. And if everything's going great, if everything's fantastic, then what we find ourselves in and what we're looking for is we're willing to pay more for it. If we really like something, we'll pay more for it. If you really like that watch or whatever, it doesn't matter. You'll pay more for it because that's what you want. So when we came into the new administration, we had a lot going that people were like, oh, wow, we're going to just absolutely explode to the upside. We're going to have M&A activity. And now M&A activity is down something like 23% from last year because of the level of uncertainty. And then, the deregulation is going to open up and that's going to change everything. All of a sudden, people are saying, well, we're not really seeing that. And they're starting to look at the things that they're seeing, and that's creating more uncertainty. It's not a political statement. It's just a fact. From where we were in November to where you are now, you have more uncertainty than you had. And that is linked to tariffs and shifting geopolitical alliances. There's a lot going on, guys. There just is. So when we look at something like this, what Yardeni's doing here, and you can spend some time on this yourself, but it's a really important concept. Again, I don't know why we have the colors that we do, but we do. And this is the hand that we're dealt. What he's doing here is he's lowering the forecast. He's saying, I used to be between 22 and 20 or 22 and 18. I'll cut out that clip and we'll walk through it in a second. Let's say you're between 22 and 18. Well, now you're between 20 and 18. And what he's saying is, based upon the uncertainty, I'm thinking that we should take a 10% discount to the PE and drop it from our 22 level down to our 20 to 18 level. So if you start taking the earnings of the S&P, what that's going to do is that's going to drop your expectations of the S&P and where you think it is. And again, this is a really important concept. A lot of people are going to listen to what this guy has to say because he's been around for a long time. Two, he's been dead right a lot on a more longer term thesis. But this is a really important concept to get. What are you willing to pay for something? And this is part of the market that people aren't getting. They're like, oh, well, we'll just go back up to a 22. Not with this much uncertainty. People are going to be like, we don't know what he's going to do next, meaning the administration, or we don't know if tariffs are really going to take place in April. Based upon that, we're just going to leave this at a discount. This can be good and bad because what could happen here, it's bad as you see it now because you're going to pay less for it. But let's just say this stuff all gets worked out. Well, not only do you get better earnings and better price to sales, but then the PE expansion. Now you're willing to pay 22 again for it. And that's where it gets super interesting. I'll put the full link in the free newsletter, but I just want to clip out a couple things here so you can see it. We didn't change their outlook for forward earnings, which is important. We just went through that. But we did lower our range for the PE from 18 to 22 to 18 to 20. So what he's saying is, does this market deserve our highest multiple? And he's saying, no, it doesn't. And I think that's very important. That's why I wanted to share it. Now, this is his thesis on why we have corrections or pullbacks in the market. Corrections occur when the stock market starts to discount a recession that doesn't occur. So in other words, we're dropping right now. Do we get a recession? Do we not? Do we start seeing earnings or do we not? It's almost always attributed to a drop in the forward PE, while forward earnings continue to rise, or at least don't fall. So in other words, what he's saying is it's always attributed to a drop in the forward price to earnings multiple. So you're coming in because of the uncertainty. So if you think about it, like, do we have more certainty? Do we have less certainty? I would argue today, at the time of recording this, that we have more certainty than we did 2 weeks ago. We know that there most likely will be tariffs. We know that we're further along with the Bank of Japan. We're further along with FOMC. We've been through earnings. So you're starting to see a little bit like we saw Friday at the close. People will argue what it was with the buying. We'll get there. I think that when you look at this, yeah, people are looking at this and going, yeah, you have a little more certainty right now. A bear market typically occurs when a recession happens, sending both valuation multiples and earnings tumbling. So in other words, the PE will contract. So maybe that 20 to 18 goes to an 18 to 16 or an 18 to 14 or 16 to 14, something like that. And earnings expectations tumbling. Only a few bear markets have occurred with no recession. And that was 62, 87, and 22. I would argue that we did have a recession in 22, personally, but it is what it is. So I hope you found this helpful. Let's get to it. Now, for shorter term, just trading perspective, and what I'm trying to do is give you different perspectives, different trades, different kinds of ways to look at the market. And this is just straight up technical. And they do a really good job. This is Sentiment Trader. This is their little symbol down here. I subscribe to them and I've talked to them and it's fine for me to share. So I thought this was pretty neat. So these red dots show 5 months low. So we hit a 5 month low, 5 month low, 5 month. Out of that, close is a percentage on the intraday high and low. So then you have your levels marked off here at a 92. So close as a percentage of the intraday high and low. So off that bar, what are you getting? You're getting a 92% close on that entire bar. Well, that's kind of interesting, considering that you don't have anything like that. Now, a lot of people say, well, it's quad witching, and it's this, and it's that, and it's JP Morgan with their super special puts. Okay. So if you look at this data, do you see any other time we had a one-day rate of change? Remember, guys, when you look at quad witching and all this other data, is it important? Yeah, but it all works itself out until the end of the day, and then they start putting their new positions on. That's why it's so important to watch the end of the day action. We're going to get there. But if I look at this, you moved substantially to fill this requirement. And then the one-day rate of change on this bar, if I'm to look at everything else here, you only really have one other time that this happened, and this was in November, and this was during the election. And you did rally up and come back and retest that level. Now, we're going to have to talk about this because the idea that straight up is a pattern, it's not. And we'll get there. But understand this. This is where we're going. So on a short-term basis, if we took data that fit 5 month lows going from 20 to 90 on a bar intraday and spiking the one-day rate of change like this, where does it get us? And I think people would be a little surprised that the closest bar that you're getting on a rate of change is that of the election versus what just happened on Friday. Of course, we'll hear about the options and how, it's different this time. Okay. After it closed 5 month low and bottom 20% of its range, then gained 2%. Got it. So I had it at 64 and then we never had it. And then 2003, and you can start seeing we get them a couple of times. I think it's important to note that this is not that common. And it did mark where we had huge sell-offs, and it did mark those areas where we did see some kind of bounce. There are some here that look like little V's. There are some that pop and then you roll right back over. Now, I like looking at the data sample and what happened the first week, second week, and then through time. And then you can look at those dates and see if there's any correlation to it. So for me, I would look at this and say, well, certainly it's not like the pandemic. But if we looked and we totaled all these up, which has already been done, you're roughly around 73%. A week later, you're higher. So, okay, that might be of significance to know that, hey, after this happens on Friday, the next week, you tend to follow that. All right, that's significant. But what you'd want to do is go through this and say, are there any crazy outliers here? I don't really have anything that I view as a crazy outlier. I mean, you could make an argument it's just like the great financial crisis if you think things are going to get that bad. I don't think you can view it as the pandemic level event. That's just my personal opinion. But I do think that you want to go through this and say if it's going to be like the great financial crisis, it gets worse in here. And I don't think that that's where we're in. But if that's your sense of it, that's why I include the data. So you can see like, yeah, you rally for a week and then it's on and then they just smoke us. If that's where your head's going, cool. If you think it's like 2000 and you're here, which I don't believe we're there, but if you do, you can see the data and you can make that decision for yourself. My personal opinion in looking at this data is looking at it from the lens of what I'm saying from 22. That's really what it reminds me of, because I have a lot of similarities, not only in technical breadth work between 22 and now, but also the way that Michigan consumer sentiment held. And that's a big level for me. Before we look at a technical level, I just want to show you why we're looking at it. You can see very clearly where we are right now and how we've just fallen off a cliff. And it's getting us back to those levels that were really like the great financial crisis. Really kind of crazy that it's even less than where you were during the dot-com bust. You're not really at that pandemic level, but this is pretty nasty, and it's pretty nasty how far it fell and how fast. So what happens to me is those levels become demarcation, and that's exactly what this did. This is that level right here. We rallied up. We had a god-awful number. We actually even gapped down on the number because it was so hideous. And you can see the gap right here, like, oh boy, that was bad. We actually just imploded, and you came right to that opening. You held, you tried to rally back up, got rejection at the gap, smacked it again, and you held. This is a really significant level for the market, and you can just take that exact level, mark it on the S&P or futures. But if you're a short-term trader and you're not marking that off, you're at a huge disadvantage. The other thing that you can do from these levels is take the trough valuation and just drop a VWAP and then watch how you're acting at that level. The tests are what's important to me, getting near it, bouncing off of that on Thursday, which is kind of interesting. Gapping below it this Thursday and then popping out over it, complete Matumbo at 11, but by 12:20 over test rally. And I mean, anybody can see that. It's not rocket science, guys. So all the people that have been in from the low back here are all of a sudden now using that as a demarcation line. So I use VWAPs sparingly. There's specific spots that I think that it's worth your time. I think the bottom of a chart, especially if you're a short-term trader, is definitely an area of interest. You want to see if the people that bought the low, on average, are they winning or are they losing? I think it's certainly of consequence. A couple other things that are really developing here besides the short-term level or some of the sectors. Very quickly, you cannot have a bear market if you don't lose financials. And it's just not possible. And what's happening here is we're not starting to lose financials. And there's a couple of reasons for that. We're going to get into it. But if you look at the financials here, we came back and retested that January 10th level after hitting a high. Yeah, we retested that level. Are we going to roll again? People say yes, people will say no. The bottom line is nobody has a clue. This is what you do know about it, and this is what I think is very important. That's your 200-day moving average. You cannot have a bear market, like a full-blown bear market or full-blown like correction for a long period of time, if you have financials up here. It's just not possible. You can go look at it through history. There's no time like that. Now, are you going to hit the 55 and reject? I don't know. I don't have a clue. You could, but you're going to want to watch that. Here's your peak VWAP, and I think this is really important. Over, test, held. Broke below it, over, test, held. So you have a little bit of a pinch in here between that and there, and you're definitely going to want to watch financials. What I thought was really important on Friday, and you look at names like JP Morgan and Goldman, here's your 200, there's your test, here's your 55, and maybe you get there, maybe you don't. But look at the buying from this level on. Like from Friday, that Michigan consumer sentiment data, and this is why it's so important to understand and why I'm like obsessed with the stool and getting people to get this stuff. From Michigan consumer sentiment data, you've done nothing but go up. That's all you've done. All you've done is go up. So from this level on, it's working. So they're buying financials because they know like that is a trough valuation on anything. And I think it's kind of interesting to think about the world that way a little bit. Now, are you going to get all the way back? Are you heading to the highs? I personally think that you have a shot at it, but there's so many moving parts. You can see it with Goldman too. Do I think you have a shot this week? No. You're going to have to look at this stuff and start thinking about who you are as a trader. And that's one of the things I'm trying to get really out there. I always say it in the community. If you're trying to get into the community, there is a wait list link in description. But if you take a look here, you just got to have to look at this stuff and go, all right, well, we're probably going to get up to these levels. And then the other thing that I would do is not, again, VWAP all over myself, but I might just want to know where the peaks are. Like, hey, where are all these crazy kids at? And they're all up here, in their hopes and dreams are smashed. And now, 46 3/4 is a level of interest. I also think there's some other developments with money coming into the country. I think we're going to get into that on Monday, but I think that's really good stuff. If I take a look at the SOX, this is where it gets kind of goofy because I need the SOX for the NASDAQ, and I'm just wondering if they're just going to rotate into financials because it's just so much easier. You're holding this level, bonk, bonk, bonk. Like we held it 3 times, like 3 Matumbos. It's exactly what you want to see. Everyone's like, oh, well, you have this death cross. Well, if I sold the day of the death cross, and then I didn't buy back, how'd that go? See, these are great in trending markets. If I'm not trending, then I'm using a lagging indicator to make my decisions for me, which is exhausting. I don't have a trending market here. So if you were selling these breaks to short, you just didn't make any money. You had to do the exact opposite of what you thought you had to do here. Now, as they're starting to get wider apart, like that's not great. And Micron, what they did on Thursday night was not great. Either, and you can see the 200-day here and how it's just respecting that over and over again, Matumbo, 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 right? And so we have to look at this and judge it and say, okay, well, maybe it's not semiconductors. And then that leads you to something like NVIDIA, and people going, oh, well, NVIDIA is clearly broken. I mean, is a death cross on NVIDIA like a warm and fuzzy sign? Like, no, that's a problem. And it's definitely an area there that you have to get over. But just as fast as these things happen, if you get over them, they can revert themselves. But you're not there. When you go in Monday morning, this is what you're dealing with. Everyone and their sister is going to be talking about it. Death cross, death cross, death cross. And do they work? Yeah, you need to pay attention to them. You can't pretend that it didn't happen. I mean, it's there. So if we lose semiconductors, you could do, the question then becomes like, what becomes the driving force? I think this is where it gets super interesting because then you look at something like XBI and you realize that XBI hasn't gone anywhere, but wait, there's a death cross. There was a death cross here and then you went down a little bit and then you came back and then there was a golden cross here. And if you bought that, maybe you made a little money. I don't think when you're trending like this, saying death cross, golden cross, death cross, I just don't think that is extremely helpful behavior unless you're trying to pay market makers. If you're not trending, looking at them is kind of pointless. If you're trending and you get them, you might want to pay attention to them, right? Okay. If you're not trending and you're basing, do you really need to pay attention to them? I would argue that you don't need to pay as much attention to them, that there's other things to pay attention to. But going out on the weekly, you can see the 200 week on the XBI. So then I might go and say, all right, well, what about IBB, which is a little different? And yeah, you still have issues here. So is this going to be our driving force? I'm not sure yet. I'm not sure that I'm ready to rule it out either because it's very clear it's not the SOX. I don't think anyone thinks that the SOX is going to miraculously hold here or that, you know what I need to do? I need to really put more money to work in semiconductor. Here's your base and this is your main level from December 30th. You did get there. You did hold. So then, all right, well, what's our driving force? So then we go and take a look and say like, well, maybe it's IBB. Is it cloud name? Well, cloud's kind of interesting because, again, you have this trend where you're going higher and then you're fighting that 200-day and you're holding it. But there's a death cross. Well, if you stay over the 200, there's not really going to be a death cross, right? I mean, you can't be above a death cross. If you are, you really don't have a problem. And then you start looking and go, okay, well, this is where the death cross was. And then how'd that work out if you took it? Well, you were down for a week or two and you were feeling really smart, and then you weren't feeling so smart. And then if you bought this, you're buying that golden cross. How'd that work out for you, right? So you have to look at these things in the context in which they act. Now, if you're looking at something like this, and you have this huge wide disparity and you're ripping, that's very different. That's a very different way to look at these because you have this huge trend and then you're having a cross on those huge trends. Do you have a huge trend here? Not really, no. And you're already so overdone and you're not even tracking it. So I look at them and I want to know the difference in the spreads. I want to know the angles. There's a lot to it, in my opinion, than just saying, oh, we're crossing again. Because here you just would have got chopped up. Again, market makers make money off of that stuff, not you. So I don't rule them out. No, you want to look at it. But you need a driving force. So then you kind of look at like the IGV and maybe it's expanded tech and it's more of that kind of tech. And you're like, okay, well, we're still fighting that 200-day. All this has to be taken into the context of, let's get rid of my levels on the queue for a second. This is what the queues look like. It's not great. Like, let's not delude ourselves that this is something warm and fuzzy. Can you bounce? Yeah. Do I think there's a bounce out there? Yes, I do. And I think there's some data to support that. And we'll go through a couple names here. Does that mean that everything's better and rosy? No, you're going to need a macro change for this to happen. What would that look like? Russia, Ukraine ending. Tariffs going, just kidding, guys. Something like that for this to all go away. And if you think neither one of those events are there is zero, I have news for you. They're not a zero. The current administration loves creating chaos and then coming in and then, and then fixing the chaos. It's not a political statement. Just go look at 01, 0.1 or whatever you want to call it, 1.0 of the administration. It's not good or bad. It just is. So I don't know that we can't see something like that here where you get some kind of driving force. I do think that everybody wants some level of peace. And what would that do to the markets? Well, the inflow of capital that would go to places like Germany and the DAX is going to be insane. The day that you no longer have sanctions on Russia, it's going to be absolutely insane. So that could be a driving force that goes into the market. But what's really going to drive us here? Well, innovation, buying, things like that. Do we have that right now? Not really. You have people scared to spend money. So we don't have that driving force. So let's go back to this and understand that you're heading for a death cross here on the NASDAQ. And let's not delude ourselves that the last one was here and it was after a huge run. And how did that go? Well, it didn't go very well for us, right? And so did we have a huge run? Well, yeah, we did. So we have to look at this again from context and say, you need to be aware of this. And again, the simple way for me to do this is just go out here, look at those two numbers and go, oh, okay, well, we're getting closer and closer. And then eventually, if I look at that spread, it's 20 points away. And then you go, okay, well, that's going to take probably, 2 to 3 weeks before we have a death cross. So if I'm not over that 200-day in that period of time, which looks like 496 or 500, which is really what you need to see. You need to see a 5 handle again. I have a problem. And don't delude yourself that you don't. But that doesn't mean that you can't bounce into it and then roll back over and then start to build. Remember, guys, V-shaped recoveries are not the norm. They're extremely rare. But we need a driving force. So when I start looking at that, it starts making me think, is it going to be some of these biotech names that are coming out like the TGTXs and how this stuff's ripping? It's not usually going to be the Reddits and this kind of stuff, but Reddit is holding that 200-day moving average, and as somebody pointed out in the pre-market, and I am going to go live Thursday night. We're going to do a live Q&A. I'll have a spot where you can put in questions that I'll answer in that live Q&A for Thursday. I'll have it set up by then. But you are holding like those levels. So is this an area of interest? Yeah, it is for names like Reddit when you start to see this stuff holding. But do we have an index or a sector like we do in the S&P that's holding? And the answer is no. Maybe it's biotech, or maybe the SOX is washed out. So maybe. And I don't know how the SOX is washed out. If we start looking at things like ASOX and we're starting to see that, yeah, we're holding those low levels here, which is the AI semiconductor space. What I would say is this. If I look at something like KLAC and I look at something like an AMAT, which are the capital equipment manufacturers or Lam Research, they're holding. They're not going higher. They're holding. ASML, they're holding. So we're not falling apart there, but the high flyers are definitely in trouble here. And I think that we'd be remiss to not think that. Now, AVGO held. So what do we have here? Well, what I tend to do is I tend to trade and look at the bottom. So about 2 days ago, in the community, we started looking at stuff like this, and I'll just show it. I posted this on Twitter. I'm probably going to start posting a little more on Twitter if you want to follow me there. And I think I'm going to start doing more on social media, just like open Q&As and stuff like that. But if I'm to look at this, let's click this really quickly so you can get this concept down so you can do it for yourself. Let's just click the keep drawing button. If I'm looking at these levels where we sold off and then bounced, and it's always under this, they're always under this level here. And you can see that very clearly for yourself and where these are areas of interest. I'm not going to do the earnings because earnings are earnings. But if you look at these are areas where you bounced. I came back down, I retested. What do I have here? And I have a what? I mean, it's pretty clear that we are holding in here, right? Came down, but look at this discrepancy here. So to me, that's a divergence, just on a discrepancy basis. It's actually not, it's actually a little. But what did we see coming up here? So I was sort of buying this in like the 230s. And this is the point that I'm getting at. People are going to wait, and they're going to wait for, I got to flip this, and then I have to get over that. By the time all that happens, man, it's done. So you have to start using different tools in the toolbox because you only might get 275 out of it. So do you want 224 to 275? I mean, I do. Does that mean that we're going back to the highs? No. So again, what we're doing here is we're using different tools in the toolbox. I would start using stuff like that. Wow, this just got crazy. Hold on. There we go. You start using different tools in the toolbox. I don't have a driving force there. Until I have a driving force, this is what I have to use. But it's definitely telling you something. For example, you look at something like a Meta and, we got to get out of Meta. We definitely have to get out of Meta. Or we're going to do this, and we're going to say, well, Meta just got above the 5, so I shouldn't get in yet because it's not pointing up. And there is something to the color coding, not when you're falling apart. Instead, you're looking at this going, well, we held 575 over and over again, and we can't get 6 over 610. Depends on who you are and how you're trading. So if I did the simplest of things here, and if you're interested in this kind of stuff, I'll do more and more of it, but I'm not going to do too much more because I try to keep these videos relatively short on a Saturday for obvious reasons. But if you look at something like this, and you're like, okay, well, that's my trading range. I mean, anybody could see that this is a resistance and that's a support, right? And then you go to like a 4 hour and you start dropping stuff in like this, and you're like, oh, well, we hit a low here and we hit another low. That doesn't mean you have to buy that, but now this becomes a target. And then what you do is you drop your time frames down, and then you use the other support and resistance lines to find these targets and to trade them. Like you're like, oh, well, we hit resistance there, so I definitely still don't want to be in that. And then it comes back down and holds. You're like, oh, okay. And then we'll see resistance become support. This is what I think you should be doing on a short-term basis with the NASDAQ, where I think the S&P is setting up something very different. That's it.